Hello everyone. My name is Kamal Manocha. I represent PMS AIF World. This week is dedicated to Lord Ganesha, who is associated with wealth, wisdom, and knowledge. And when I think of these three attributes exactly drive all of us at PMS AIF World. When we created PMS AIF World, we were always passionate about wealth, wisdom, and knowledge. And that is where we started the rhythm of doing weekly webinars. Whether it was COVID crisis or maybe the buoyant times after that, we have continued the rhythm of doing weekly webinars. And in that context, today being Friday evening, we are again, bringing to you a very interesting format of another very interesting topic, absolutely appropriate in the current context of markets. Where the topic today is that what is the approach, what is the investment approach to make stupendous wealth from equities across cycles. We have seen, for last almost 5, 6, 7 years, the growth style of investing, where there was no valuation consciousness, was actually making a lot of wealth. And suddenly value consciousness emerged, when the highly valued startups, disruptive businesses, so-called highly valued businesses in IT, they saw a deep correction. Many times investors over the last 5 years have believed that there are certain sectors, certain businesses which do not follow cycles. Investors feel that consumers, FMCG, pharma, IT, they kind of do not follow cycles, but recent history has proven all of them wrong. Even they follow cycles. So what is that approach, which can actually understand what are the cycles which are ahead of us, and how do we create, consistent wealth across cycles is the topic that we want to understand today, from the speaker, Mr. Jigar Mistry, who is one of the co-founders with Buoyant Capital PMS, which has a 5-year plus history, started in 2016, has a decent and a very good track record over the last 5 years in terms of generating consistent alpha over the benchmarks. The team-based approach and working across cycles is what they have been kind of demonstrating, and that is what pulled us to kind of connect with them, to understand from them. And that is where I welcome you, Jigar, for this webinar. Before you begin, I will just give a background to Jigar. He brings with him 21 years of pertinent experience. He has worked with Kotak Institutional Equities. He has worked with HSBC. He is a chartered accountant, a CFA, and obviously, he has been managing public money under Buoyant Capital for last almost 5.5 years. And here, we are wanting to understand from you, what is your approach? What is your view? What is your ideology to actually, manage equities across cycles? Over to you.
Thank you, Kamal. Thank you, PMS AIF World, for inviting me. Truly an honor and pleasure to address all of you on this beautiful Friday evening. What I have in mind, Kamal, is that I'll run them through a brief presentation, tell them what we have been up to. So the fund was started in June 2016. So we almost have 6 years and 3 months of operating history, almost 75 months. We have encountered numerous cycles. It's been fun sometimes, it's been taxing a lot of other times, but there has been a lot of learning, and history, if it was any guide, that has always paved the way of what to expect as we go ahead. I would just say that a lot of sort of emphasis is placed on identifying the right company to invest. Not enough is essentially sort of put through in terms of how to be invested in several other cycles. Most people equate a good company to be a great investment at all points in time. If my singular effort today is to sort of debunk that thesis that a good company and good investment are two different things. A good company can be a good investment, but for an extended period of time, it can be a very bad investment. And through my presentation, I'll run you through sort of how we have seen that on numerous occasions in the history. And if you take home that essential thesis, then you understand that markets, human psychology in essence operates through cycles, and understanding that cycle is step one. Evaluating them is step two. And once we are able to do step 1 and 2, we are able to effectively navigate and generate reasonably good wealth. So allow me to sort of present it to you in terms of where we are and what do we do. Kamal, my screen is visible to you?
Yeah, absolutely. This is visible.
All right. So, in the first slide, I intend to sort of just summarize on who we are, and then we will straightly dive into what the investment philosophy is. But as I said, we started the fund in June 2016. We have since then registered 21.2% CAGR post fees and post expenses. Kotak Mahindra Bank and HDFC have been our fund accounting partners. So they are the ones that certify the client's books of accounts. We are just sort of the presenters of that data. And that essentially puts us in the top PMSs in the country, PMS, AIF, anybody with a 5-year track record, including mutual funds, you will really find us up there in terms of the top decile across several time periods. But sort of that is the output. Let's get into what sort of drives that. One of the important things which a lot of people don't discuss enough is the familiarity bias. Right? What happens is that when any fund manager graduates from becoming an analyst into a fund manager, and that they've been covering sectors which are, say, predominantly consumption, retail, etc., they do very well when their investment style sort of overlays with the cycle of that sector. And in the presentation, I'll run you through the different cycles. But whenever sort of those two cycles align, that's when they generate stupendous returns. And when that sector falls out of the cycle, the fund underperforms for a great length of time. We have seen cycles go on for 5, 10, 15, 20 years. And that's a very large amount of time to essentially not, generate superior returns. There is a way in which that can be addressed. We have sort of adopted that. Three of us are chartered accountants who co-own and run Buoyant Capital. Viral is an MBA from IIM Ahmedabad, predominantly ran Reliance Life Insurance, almost 22,000 crores of debt and equity. I was last director of research at HSBC, and before that with Kotak, which was then a JV with Goldman. And Sachin is also CA and was last with Reliance Mutual Fund. But I think the way where we are very different is that, we don't essentially run the fund as one fund manager, right? All three of us specialize in different areas. Viral has covered IT, consumption, FMCG, etc. I have covered banking, global utilities, global commodities. Sachin has covered auto engineering. And essentially, all three of us sort of specialize in the areas that we operate in and divide the fund in which it is a co-management approach. Historically, that has allowed us to run the fund in a way that it, surpasses the cycle and cyclical performance that several funds get caught into. And, it operates through the cycles. The another important part is in terms of framework, and this is just the overall slide, so we'll come to all of it in a lot more detail. But I think if I highlight the framework, that's essentially very different. And, I'll just briefly draw sort of what tends to happen. So essentially, if you sort of look at, any investment manager, their idea is to essentially operate the fund in a way where, okay, sorry, I'm unable to draw. Give me a second. Okay, I think that's not happening. So what tends to happen is that, whenever you are sort of looking at identifying a great business, let's say, that is compounding any fundamental value, say free cash flow growth or earnings per share growth, you find a company like that and you want to sort of invest into it. The main thinking that goes behind it is that a company that's growing earnings, say, consistently at, say, 15 or 20%, it is erroneous to assume that the share price also compounds at that same rate, right? What tends to happen is that the share prices sort of move ahead of fundamentals on many occasions, and then it flatlines for a fairly long period of time till the time prices catch up to the fundamentals of the company. And that essentially creates those cycles, right? The cycle is essentially created because earnings might be growing consistently, but share prices do not compound consistently. They follow cycles, and there lies the opportunity of practicing what we do, which is a cross cycle investing or a business cycle investing. There are times when a good company becomes a great investment, and there are times when a good company becomes a very bad investment. And we will delve through it in a lot more detail as we go ahead. The second last point essentially is in terms of execution, and that's an overlooked point as well. That whenever you are in, let's say, a mutual fund or an AIF, then you are essentially 100% invested the day you give the money. Now, even if you are running, say, a 20 or 25 stock portfolio, not every day the money hits your bank account. Not all 25 businesses are buys, right? That you are probably in the process of selling out 3 or 4 of them, or probably, let's say, you're very interested in banking and it is, say, August, September 2021. You know that FI selling will mean that despite the rising fundamental value, the share prices will come down, and you want to stagger your investment purchases. Now, mutual funds, AIFs don't afford you that opportunity, but PMSs do, right? In a PMS, because you are running an individual account, there is this ability to get a staggered position based on however you are thinking in terms of your portfolio. But a lot of PMS managers don't end up doing that. They run a model portfolio, which essentially beats the purpose why a PMS is structured. At Buoyant Capital, we essentially don't run a model portfolio. We have worked with an IT company to create a solution where each portfolio is independently evaluated at our end. And if we are aggressive, we get invested fairly quickly. If we are defensive, we take our time. Historically, we have taken 6-8 months to get fully invested, so that you are able to correctly build the start of the portfolio and then essentially take it forward. The last point, but not the least by any stretch, is skin in the game. I think a lot of investment managers don't talk about it often, but this is very crucial because the interest of the fund manager and the investor needs to be aligned at all points in time, right? The easiest way to undertake that is to give the skin in the game in a way where the fund manager's portfolio and equity investment is run in the same way like you run your client's money, which is what we do at Buoyant Capital. As of last calculation, some 35 odd crores is the value of our investment into the Buoyant Capital portfolio, and it is run in the exact same way like we all run our investors' money, and therefore it achieves a complete alignment of interest. Let me now delve into how we see the world essentially and how we operate in the world that we see. The fundamental point is that human mind thinks in linear terms. You go from point A to point B, a significant amount of time passes, and you start believing that you went there in straight line. Right? Think of COVID. All that we remember of COVID now is what a great investment opportunity it was. But when you go down, you understand the kind of drawdowns, the kind of confusion that was prevalent. It was not a clear-cut case where, once the market bottomed on 23rd of March, that it would stay the bottom and, things would go up in one straight line. So when you look at the data a lot more closely, you will start finding the cycles which can help your investment. Right? Let's start with this simple example of market caps. Now, if I look at a 20-year history, right, Sensex has compounded at 17% CAGR, mid-cap index has compounded at 18% CAGR, and small cap has compounded at 19% CAGR. Right, 2 percentage point over 20 years can mean a lot. But when you sort of look at and zoom the data, you find very interesting prospects. So, for example, we have broken this chart into 2 parts. On all the top half of the chart, you will see the market up cycles. The dark gray bar is the small cap index, the light gray bar is the mid cap index, and the red bar is the Sensex, or we can approximate that for a large cap index. And on all the bottom, there are the down cycles. Now, if you look closely, and it's intuitive to all of us, that whenever there are market up cycles, the small and mid cap tend to outperform the large cap. Right? And whenever there are the down cycles, the small and mid cap underperform. As I said, intuitively, we know this. But look at the cycle on December 17 to March 20. That second from the right hand side on the bottom. During this cycle, December 17 to March 20, the large cap index fell 12% and the small cap index fell 50%, right? 50. At that point in time, if you were operating in the market, it would have become very clear that the entire market narrative had moved to the discussion on how, India has only this 20-25 great quality investable businesses, and rest everything you should just forget about, right? We know FIs will invest only in these businesses, and domestic investors know FIs will only invest here, and therefore all of us should only look at those 25 companies. However, when the market cycle turned and you look at the top right chart, the 3 bars with numbers in them, when the market turned, right, the small cap index took out the entire underperformance of 3 years in less than a year and a half. Right? It was up some 200%, whereas the Sensex was not up even 100%. And that sort of is creating the cycle. Now, yes, 2% each year would not tell you a lot. But when you are confronted by a thesis where small cap is down 50 and the large cap is down 12, intuitively we must start realizing that this is part of the cycle and start looking at data in a way that helps your investment process. Let's look at the next example in terms of sectors, and that's equally interesting, right? We have sort of circled out 3 different time zones. We have taken 22 years of Sensex and broken them down into 10 cycles. Now look at the last gray circle, right? That's the COVID downturn and the post-COVID recovery. In the COVID downturn, FMCG was the best performing sector and metals was the worst. And when the recovery happened, the exact opposite happened, right? Metals outperformed FMCG by a huge margin. And this is recent. We know something like this has happened. We recognize that the cycle has changed. But when you look at the previous cycle, which is the red circle before that, during 13 to 15, when there was a taper tantrum downturn, consumer-facing businesses were the best performers. And during the upturn that followed from 17 to almost 19, consumers again became the best performing sector. Right? So whether market was down or up between 2014 and 19 for more than 5 years, market can be down or up, but consumer-facing businesses were just outperforming. And that led everybody to believe that, consumption-facing businesses are these great businesses, 50p, 100p, doesn't matter. You have to just close your eyes and start investing because essentially these are companies with great moats. We tend to forget that during 14 to 19, your commodity price inflation was negative. Crude was down 30-35%. And therefore, whatever price increases these companies took was essentially flowing through their profit bottom line. However, if you managed to buy, and kept on buying consumption, if you had bought it in 2019, 2020, for the last 3 years, your portfolio has not been making money. And this is not new. If you look at the previous cycle between 2000 and 2008, the same cycle happened with capital goods. The whole index was up multiple times. But had you bought in 2008 peak, you would have to wait 11 years for your investment to return to parity. I'm not saying generate a positive return. Just to break even took 11 years, right? So not just market cap follows cycles, sectors follow cycles, and this is going to be interesting where I'm saying that stocks also follow cycles. So I started the presentation by saying that, look, you identify a great company, it's only half the job. What to pay for those businesses is equally important. And here I've highlighted 4 companies. I have close to 20 more companies if anybody wants to know eventually. But these are the businesses which were always great businesses. These were the companies that were growing earnings, but for an extended period, the shares went nowhere, right? So top 2 are international companies, the bottom 2 are Indian companies. You start with Coca-Cola at the top left part. And look at what happened. So Warren Buffett bought Coca-Cola in 88 or started buying in 88, 89 largely. And for the next 10 years, the stock went up 10 times. right? Phenomenal performance. What a great company. Everybody realized it's a great business. However, if you kept buying and had you bought it in 98, for the next 19 years, during which time their earnings doubled, the stock return was essentially zero. Right? It's surprising. IBM, the top right hand side, earnings tripled. The stock return was zero for 12 years. Always, these two are great companies. The bottom half are Indian companies, consumption facing businesses. Colgate, right? Colgate, between 94 and the next 15 years, till 2010 almost, quadrupled its CPS. Right? For 15 years, the stock price was zero because what you pay for a quality business is equally important. Hindustan Unilever on the left hand side bottom, for 10 years when EPS doubled, that 7% CAGR, essentially stock return was zero. So not just different indices are following cycles, different sectors are following cycles, and different stocks are following cycles as well. And if that is the scenario, we should actually start thinking of investing through cycles. Now, what is it that we do, right? How should you think about those? We essentially break down our investment process or investment coverage into two parts. One that is core to our thought process, and other is satellite. Now, a lot has been said about what is core and what constitutes core, so I'll not spend a lot of time here. But to us, what is core is the companies that are generating predictable cash flows. They tend to be industry leaders, and they are generating so much cash flows that they don't need it for growth, and therefore they have a very well defined reinvestment structure, right? The market thinks that this is the only investable space, right? You find out a great company, stay invested no matter what. We believe slightly differently. We think this is an important investable universe, but the ignored one is even more important, if not equally important, because you find opportunities that are essentially great here. So we call it satellite. We further break it down into three parts: cyclical, turnaround, and value. Right? Cyclical are typically those mean reverting series. Take, say, for example, Tata Steel between 99 and 2019, right? For 20 years, if you looked at, let's imagine we are in 2019, you look back 20 years, the starting price of the stock was 275, the ending price of the stock is 275. Investors sort of looked at this data and said, look, it's not worth investing here because, 20 years shareholders have not made any money. We look at the same data set and realize that, on three separate occasions, Tata Steel was below 300, and on three separate occasions, it was above 800. So essentially, can you devise a mechanism, a risk-based metrics where you can participate, right? All of us know you can never buy at the bottom, never sell at the top. But even if you are there for part of the ride, you tend to generate significant returns. I'll tell you what we have done in the next slide. But more importantly, once you start seeing all of these as cycles, you realize that metals is a 2-3 year cycle, CV is a 5-6 year cycle. Then the commercial vehicle space follows cycles as well. It's a 5-6 year cycle. And NBFCs eventually is a 7-8 year cycle. But essentially, all of that is following a cycle. The second is the turnaround. This is again very interesting because we have all gotten very used to, segmenting companies as good company and bad company. But whenever we realize that there is a disruption going on, we find that the disrupted company can come back very strong. And at that top of disruption, those look like very bad companies, but essentially are great investments, right? Take the case of Bharti. When Jio came in, there were 13 telecom companies. Where Jio was done with its freebie offer, there were only 3. Now, at the peak of that disruption, Bharti was losing consumers, it was reporting losses, it was a negative free cash flow. And one way to look at it was like, this company cannot hold on to its customers. What's the sort of plain looking at it? The other way to look at it is that in no country there have been fewer than 3 telecom players. And even if in India there were only 2, Bharti would have been the second one. So your question and your thought process should have moved from asking whether it's a good or bad company to asking whether 2 or 3 player market. And when Bharti bottomed, it essentially went up 4 times after that. The third subcategory is value, where again, all of us are so enamored by the leadership position that we essentially value leaders at disproportionately high valuation multiples, right? And therein lies a case where it effectively catches on. Take the case of life insurance. HDFC versus say Max. HDFC Life, HDFC Group is a great group, but HDFC Life is a good company. It's not the best in class when you look at, the agency force or the product palette or, just the numbers per se. Max Financial stands out, but because that was HDFC Group, it was getting valued at 4 times price to embedded value. Because this was Max, it was getting valued at 1 time. And over the last 3 or 4 years, the valuation has evened out, right? So whatever is a superior run business, no matter what the market narrative is, over periods of time, the valuation evens out. Take the case of ICICI Bank versus HDFC Bank over the last 3 years, right? A very similar thing has played out. So if we can bifurcate what we think is core, predictable businesses, leadership positions, and then what the market hates to own, or at least the institutional investors hates to own, and call it satellite. Now, having identified what is core and satellite, we interact with it in one of these two stances. We are either aggressive, at which point in time the idea is to generate superior return, and at that time satellite is a larger proportion in the portfolio than core. Having generated superior return, we want to turn defensive and protect the capital, at which time it inverses. Satellite becomes a smaller part, core becomes a larger part. This is exceedingly simple in terms of theory, but when you start executing, that's where the interesting points lie. Right? So this is a very interesting slide, arguably the most important in the presentation, where we are sort of breaking down the returns in terms of weights and returns, right? So gray bar is the benchmark, which is BSE 100. The red bar is Buoyant Capital. On the top half are all weights, on the bottom half are returns, right? So the way to read this is that over the last 75 months, which is since inception for us, BSE 100, which is our benchmark, has invested 76.6% capital into sectors that we think are core and generated 105% return, right? That's a good return. Buoyant, in comparison, has invested 42.4% capital, but the return generated is much superior at 132%. This is, we are not even talking about the satellite sector here. We are talking only core. And within core, if you identify the right sector, if you identify the right companies at slightly more than half the capital allocation, you can generate a superior return. But the fun lies in the satellite portfolio, right? So the right-hand side you come to, the benchmark has invested 23.4% capital and generated a very minuscule return of 15%, right? So most professional investors would just show this data point to you and say, look, in satellite, in cyclicals, you don't make money. In turnaround, you don't make money. But if done right, the Buoyant numbers are in the red, which we have invested 57.6% capital, but generated over 100% in returns, right? Move to the total right-hand side. In cyclicals, we have invested 2.4% 2.4 times the benchmark, but our returns are 4.7 times, right? Turnaround, 3.5 times capital invested, much superior returns. You get the drift. But the other way to look at this data is looking at it sliced by time. And this is again very interesting. It's for a period spanning June 16 to August 22. And for the first few months, we ran an aggressive portfolio from June 2016 to October 2017. And the Sensex was up hardly 20%, whereas the portfolio generated 63% return. Now, having generated superior return, most investors got carried away, right? They kept on investing into small caps. They kept on investing into those cyclical businesses or stories that had a lot of embedded value. And when the market turnaround came, the Indian market peaked in Jan 2018, and for the next year and a half, they essentially, destroyed capital like nobody's business. We essentially had turned defensive in time. Till Feb 2019, the broader market was down. Our idea was to protect the capital, which we did. We returned 7.6%. We became aggressive again in Feb 2019, ran an aggressive portfolio through COVID where we could, pick up a lot of quality businesses till August 2021, where we generated 72% returns and beat the market. And over the last 1 year, when we have been defensive, it's a very interesting data point. Your NASDAQ is down 20%, your Dow Jones is down 10%, Indian market is up about 4%, and we are up almost 11 despite running an ultra conservative portfolio. So if you start thinking in terms of, keeping the core at a certain level and fluctuating with the satellite, this is something that we have been able to achieve, right? Which in return terms essentially comes down to this. 2 years CAGR is 47%, 3 years is 30% since inception 21.2, which means that if you would have been with us since inception, compared to 120% for the market, we are in excess of 230%. So almost 2x the market returns. The last point I would like to highlight is in terms of communication, because this is again one point which does not get discussed a lot, where the fund returns and investor returns become very different. That's a way in which you can avoid this. Obviously, like most transparent portfolio managers, we declare our portfolio on a daily basis to all investors. That's the least that any transparent portfolio manager could do. But more importantly, we do something on a weekly basis, which we are very proud of. We write on different sectors, different investment philosophies. The articles are carried by the Economic Times, and I have put up a link there in case you want to look at the last 96 articles that we have published. For example, we became very, very conservative on the new age sort of businesses, the Paytm and Nykas of the world, where essentially we wrote in, I think it was August or September 21, that this is not a play on Indian consumerism as much as it is a play on the US 10-year treasury rate. And we essentially discussed on how, who becomes the essential funders of SoftBank and Tiger Globals of the world. And therefore, if the US interest rate were to rise, say 2%, these stocks would halve, right? And similarly, we have written about the cards business, the aluminium business, the essentially cement business, 95 articles. So essentially, you can go and read at that website, buoyantcap.com/memos. Also, on a monthly basis, we discuss markets, views on the markets, how we are positioned. That's under fact sheet, and you have given the link there as well. And lastly, in view of total transparency, we have put up sort of our media appearances, all of 130 or 140 media appearances that we have put out. And essentially, you can, go back and check what our views were at peak of COVID or in August when we were turning defensive, etc. So, in summary, yes, we essentially believe that stock selection is the core of what we do. But if you are able to understand and identify the cycles, you essentially get a very good picture on what needs to be done. Most people or most of our contemporaries believe that's where you should end. That's the be all and end all. Identify a great company and you stay invested. But we believe there are cycles, and cycles are important. And therefore, we essentially believe on turning aggressive and defensive. The other great part is essentially we have only run one fund since inception, right? It's easier to run 4 funds, believe me, because it gives the manufacturer, which is a PMS business, the ability to hide, right? I could have a large cap fund and a small cap fund and a pharma fund or a financials fund. and I could ask you to keep getting invested in different sectors. But as an end investor, you are not really following those cycles as strongly as we are. And therefore, for you to make that decision is a little more tricky. If you're running just the one fund, what precludes the manager of taking position? If you think large cap makes more sense, include in that one fund that you run. If you think finance makes more sense, include and increase the weight on financials. But running just one fund leaves very little for the manufacturers to hide, and essentially limits the opportunities and ability to confuse the end investors. By running just one fund, we go a step ahead and we invest all our money in that one fund. And last but not the least, in terms of execution, you can be opportunistic. For most PMSs, they have the ability to execute it depending on where they see the markets. A lot of people don't end up doing that because they don't have the technology, but that's something as an investors you should be on the lookout for. So Kamal, that's what I wanted to say. I'll stop the slide presentation. Very happy to take questions if there are any.
Right, Jigar. So it was very insightful. In fact, we have been reading all your blog articles. They are always very interesting, very insightful. So the foremost question which comes to my mind is that as of now, financials is a heavyweight sector in your portfolio. It is also heavyweight sector in the major indices like Nifty or Nifty 500. What are your views with regards to financials as sectors? Because we are talking about trying to gauge cycles. So in what in this context, what is the kind of expected future? And within financials, if you want to cover any sub I would say segments.
Sure, Kamal. So yeah, financials is very important, not just from indices, but also an economic standpoint. Uh, if I look at the long term in terms of financials, we have to sort of start looking at it on where this cycle started. So if you go back in 2015, Raghuram Rajan was then the RBI governor. And before that, there was a lot of evergreening that used to happen in the banking sector. So the banks would give out loans to the same promoter to repay the old loan, and they had a variety of acronyms, so to speak, in terms of how S4A and several restructuring, but essentially you were not disclosing the true health of your balance sheet. Raghuram Rajan came and said, nothing doing. You have to disclose, own up to your mistakes, and start providing for them. So then, you started seeing this huge NPA cycle. A lot of good quality banks and bad quality banks started reporting huge sort of NPAs. And over the last 7-8 years, I think a large part of those losses are now recognized and provided for. In between, there were a lot of points. So 2016, there was Demon. 2017, there was GST. So the economy got shook up a little bit. 2018 was the IL&FS crisis. 2020, there were rounds of pandemic. And that sort of has severely tested the financials and the health of all this banking and, NBFCs. There were a lot of sort of casualties in the process. But from where I see, I am seeing the balance sheets of the banks being the cleanest in at least the 20 years that I have seen. I think KV Kamath was on record to say it's the cleanest in 50 years. So he knows better than most of us do. And let's take his word for it. So now that you are among the cleanest balance sheets in banks, the next question is only one of growth, right? Over a very long-term cycle. So growth, for majority of the banks is now being driven by retail. Corporate balance sheets is deleveraged. But I think the next round of sort of capex would drive the banks to improve the growth part of it. Obviously, over the last 3 or 4 months, the credit growth we are seeing is already at record highs. But I think there is a room to improve a lot more on that. In between, we saw a very interesting valuation cycle where, what tends to happen is that if you are in, say, July or August, and you are anticipating that the interest rates will need to start moving up quickly, that has two implications. The first implication is that the dollar appreciates, and therefore FIs will have to start selling emerging markets. The other and obviously banks are the one that they own the most, and therefore they'll be forced to sell banks. So on the flow side of it, you will see a lot of selling in banks. On the fundamental side of it, it's a different story, because a rising interest rate actually benefits banks. And I have written one article in it about, I think, a year back or 8-9 months back, where a rising interest rate means that banks are able to essentially, pass on. So the assets get repriced much faster than liabilities, and therefore your NIMs tends to expand. So it was a beautiful scenario where the fundamental value was improving, but the FIs were forced to sell and go out of India, which allowed players like us to dramatically go even more overweight than we were, and later then trim it out. So future of financials, in our opinion, is very interesting. Within those, obviously, good quality large banks are ones that we own, but also there is very interesting sort of cyclical play that is emerging in terms of your microfinance businesses. Now, microfinance is cyclic, the top of cyclical businesses you can think of. Just to give you an example, SKS Micro, which was the father of sort of microfinance in India, essentially in 2011, if I'm not mistaken in terms of dates, had to write off 2 times the profits of last 10 years. Right? In one particular bad cycle, its 10 years profit was wiped off 2 times over. And that is the kind of cyclicality you are dealing with. And over the last 10 years or so, there have been multiple questions in and around, and multiple cycles that have followed, but it now is at a very interesting space. So large banks, obviously one play to have, but the other play which is emerging is in terms of microfinance businesses. And you can take a pick of which business you like, but essentially that's the space for us, is getting very interesting.
So, in the overall context, in the current environment where there are various macro challenges like rising interest rates, inflation, and maybe recessionary confirmations, not fears, in US and then in Europe and UK, and then obviously the various problems going on in China. All these issues indirectly, maybe in longer term, going to help India's economy. Is what we have been hopeful of. However, in terms of trying to understand what is this cycle conveying from the context of asset allocation, first of all, between equity and debt, or maybe including any other asset class, and within equity, apart from financials, what other sectors? So you would want to kind of correlate the current context with your experience.
Right, Kamal. So, very interesting question. And I think let's break it down into 2 parts. One is how we see the fundamental value change, and then let's look at the liquidity part of it. Or rather, actually, let's start looking at it from liquidity, because that's very interesting. See, all of us essentially are, fund managers of the QE era, right? All of us, the last time quantitative tightening was done was in 1994, right? They tried doing something in 2013, 14, 15, but essentially the market gave up, and then the Fed said, okay, we are not going to do it. We still call it the taper tantrum, right? So it's not happened over the last 25 years. And therefore, we have invented terms like time correction. Right? What is time correction? Either the fundamentals is moving up or down. People believe that because of the gush of liquidity that we have witnessed over the last 25 years, you will see valuations that will keep on expanding. So even if you have bought the business at a mispriced valuation, you paid too much and you shouldn't have, but because more liquidity is going to chase the same asset, valuations will keep expanding, and therefore if the stock hasn't done great for say 2-3 years, it's given enough time correction and therefore it's done. We believe that concept needs to be revisited now, because if Fed is serious about quantitative tightening, then those cycles are going to get more messier, it's going to get shorter, and the sector rotation needs to be a lot more quicker vis-a-vis what we have seen. Also, it might mean that your definition of what long-term investing means needs to be recalibrated, right? Long-term investing is not going to mean you stay invested in a business for 10 years and see valuations re-rate. There will be exceptions, there's no doubt about that. And good quality, recognized businesses will deliver you superior returns, but that is not going to be the mainstay and core of your investment philosophy. Now, if you come to fundamentals, it's very interesting because for the first time, we are looking at Indian inflation, which is similar or slightly below than Western economies, right? And India is actually delivering a superior real GDP growth, whereas the Western economies are not. In that context, when you start looking at the optionalities that a lot of foreign portfolio managers have, you're not left with a lot, right? Let's imagine they're not going to invest in Russia, and China is now having a problem of its own, having grown so well for the last 2.5 decades. India and Brazil then become your de facto destinations, and Brazil is still a very resource denominated economy, right? So India then sort of becomes the de facto sort of place for FIs to invest. Although we must remember that India still does not get an allocation of its own, right? It's an allocation out of Asia, and which traditionally been 10 odd percent, but that percentage can potentially increase. And for the first time, we have started hearing murmurs of funds with Asia ex China. So if that becomes a reality, that can address a lot of flow problems. The fundamental problem that India has is not so much inflation. We have lived through double-digit inflations for long. It is actually, the high crude prices, and you can sort of correlate it with inflation, but we don't understand the severity of what higher crude prices does, right? We import 1.7 billion barrels of oil, and at a 35 or a $40 higher price than last year, India owes 5 lakh crore to other companies and countries outside India. Now that needs to be absorbed in the economy. So far, they have absorbed only 2.5 lakh crores. So the balance 2.5 lakh crore need to be subsumed into corporate profits, and it's not going to be easy. We only have 7.5 lakh crores of pre-tax corporate profits. And if you were to subsume 2.5 lakh crore, it's going to be difficult. To your question on which sectors, this 2.5 lakh crore is going to be spread very differently. So if I break it down by GDP, we believe the largest impact is going to be on a consumption basket. Because not just earnings are going to be impacted, they are the largest users of commodity, crude, etc., or derivatives thereof. But because of a rising interest rate and QT scenario, their valuations will get impacted a lot. And therefore, as a basket, consumption needs to be approached with a lot of caution. Manufacturing is a pretty case by case basis. So there are few sectors which are able to pass on the higher prices very easily, right? A few chemical companies are such, a select pharmaceutical companies are such, auto ancillaries is in a beautiful space, some select auto players are in a good space, but manufacturing is going to be a case by case basis, whereas services is essentially a free for all. So services, you can identify domestic facing services likes of banks, insurance, microfinance. IT is still not a domestic facing industry, so that's not one sector we are very positive on despite its recent correction. But I think domestic facing services, if you find, there is one man guarding company that we own which we like a lot as well. So those are the sectors which I think, in order of priority, I would want to bet in year that follows ahead.
Sure. So particularly, at this point of time, most investors in the recent past have seen digital businesses, tech-led businesses, IT businesses actually, coming out to be positively in terms of perceptual risk. Many investors out here, I can tell you, would have invested into TCS, Infosys, and likewise, having seen that TCS has given buyback maybe at 4,400. Plus, obviously, some of these are larger IT businesses. and everybody in post-COVID world believes that IT as a sector is going to boom. All the more, though obviously, in terms of valuations, it may have gone out of favor at present, and hence, the view from this perspective, and you as a portfolio manager, what is your weightage to IT as a sector, and what is the view of Buoyant Capital as a team in this context?
Right, Kamal. So we don't own any of those names that you mentioned, right? Because see, there is a small but critical distinction that India does not have tech plays, right? What India has is IT services. The difference might mean subtle, but when you look at a company like Zoom, for example, right, which is the US listed business, all of us used it a lot during COVID. But Zoom can, in theory, grow revenues 5x in a year. In a COVID year, its revenue would have gone up 5x or more. For an Indian IT company to be able to do that, it's virtually impossible. Even the smallest company cannot increase its IT service revenue by 5 times because it needs to hire that many number of people. Those need to be trained. You need to find clients. So, for a larger company, growing between 15% and 17% is a huge deal. So ideally, NASDAQ is tech companies that can any given year grow revenues dramatically, which is very different from an IT service company. And therefore, with NASDAQ, the Indian IT service companies' valuation should never have increased. Now, having increased, they are now following NASDAQ on the way down, which we think is also justified given what had transpired. So our sense is that it increasingly you will see margins contract because attrition is high, availability of people on the ground is virtually very tight, and travel etc. will come back. Valuations have corrected, but they've not gone into the territory which is cheap, and therefore we think it's still time before we look at this sector constructively. Now, the tech plays that we do have, right, the new age businesses, just a brief word on those. What tends to happen is that, the companies that fund these businesses, the likes of SoftBank or Tiger Global, for them, the mathematic is very simple, right? You invest in, say, 10 businesses, and one business goes 10x over, say, 5-year period, or 100x, and the other 9 companies goes to zero, then you essentially have a 15% CAGR, right? So their business model is simple. But the investors in such hedge funds, etc., are not really equity investors. A lot of people don't know this. They are essentially debt investors, right? The likes of US endowment, pension funds, etc. Their largest exposure is hedge funds. And when they sort of invest here, right, their view is very simple, that let's say my 30-year liability is compounding at 3% per annum. Now, if a 30-year paper to me is paying 1.5%, I cannot cover my expenses. And therefore, let me invest some part of money into, say, 5 Tiger Globals. And if I assume that only one of them gives me 15% return and the rest of them collapse, I still have made my 3%. Right? So the math is so different. But what happens when a 30-year goes up and back to 3%? Those investors are no longer investors in the funds like Tiger Globals. And sadly, the companies that Tiger Globals invest in continuously need cash. So when you look at this ecosystem and you do the math in terms of your cash flows, you realize that these tech businesses have very limited virtue, and therefore it will still be time. In the Jackson Hole, it became very clear that they are not backing off from the 2% target. And if that is the case, we are still a little while away from this new age tech businesses gaining front.
So just to ask a subsequent question, during COVID period when IT and tech-led businesses were actually booming, were you at that point of time also avoiding these businesses, or you participated in that rally?
No, Kamal. So we didn't think the valuations can, or rather in theory should, get re-rated. So we missed, if you can call it that, we missed that part of the rally and did not get hurt during the correction as well. But during COVID, people were so inordinately focused on tech, IT, and pharma that a lot of other decent quality businesses were available for very cheap valuations. right? And you could pick up a lot. So I showed that chart. We still outperformed dramatically in this time despite having virtually no IT. But because very good quality businesses were available at 1 or 2 P and 1 or 2 normalized PE, and you could then get sort of positioned accordingly.
So when you identify now sectors in your portfolio or cycles in your portfolio, how big a role does valuation of that sector or a cycle or industry play?
Reasonably large, Kamal, because we are not one of those investors who believe that a good business is a great investment at all points, right? So at a certain point, it becomes a bad investment, and we exit. The way we approach valuations is not how most people do it, is looking at earnings change or PE change. We believe PE essentially is a state of mind. There is a very limited way to evaluate this, but there is a better way to us, right? We sort of believe that if we were to buy the entire business, let's say Hindustan Unilever, you were to buy this entire business and then never sell it, and therefore what you will get is only free cash flows, right? So let's say if you want to double your money in 4 years, which is say 18% CAGR, then you reverse calculate that the in order to achieve those returns, what is the market forcing you to assume. The market might force you to assume that you have to grow free cash flows at say 20% CAGR for the first 10 years and then 10% till perpetuity. And having looked at these companies and sectors for a fairly long period of time, if we believe that this is not doable, then we essentially no longer hold that business. And on the other side, typically when the markets are so focused on the ultra short term, that your essential terminal value assumption is so little that you can buy these businesses without worrying. If you buy it at 100, if you don't worry it goes to 80 first or 120 first, then there is a lot of money to be made in a lot of those businesses. So I would say yes, valuation does play a reasonably decent part in whatever we do.
So in your approach of trying to balance between core and satellite approach to the portfolio, what percentage goes into these two I would say ways of managing the portfolio?
So I displayed that slide earlier saying that when we are defensive, we want to be 70% core and 30% satellite. And when we are aggressive, we want to be 30% core and 70% satellite. The next slide, I did show that on a weighted average basis, over the last 75 months, we have been 43 odd percent into core and 50 some percent in satellite.
What percentage of the portfolio currently is in mid and small caps at present?
We should be, I will check the fact sheet exactly. We are still sort of writing that for August. But my sense is that we should be around 30 odd percent in small and mid caps. Okay. At the peak of COVID, we were roughly 70% in small and mid cap.
Right. So there has been this new learning, that investors have had in last, I would say 5-6 years, and especially it is based on the bad experience in last decade for equities and asset class, where from 2010 to maybe 2018, they saw various boards of market going up and down, but essentially, various portfolio management services as well as many mutual funds did not make much money. Though obviously there was a rise in 2014 followed by 2017, but there was a massive fall in 2018-19, and that kind of made investors focus too much on businesses, and they learned this context of consistent compounding, wherein which they feel that it is obviously good to have a consistently growing business in the portfolio irrespective of its valuation and irrespective of market cycles, because if one focuses on trying to churn portfolio, focusing on the changing macro and trying to identify the next trend and next cycle, that is maybe an inferior way. A rather superior way is to stick on to businesses like Titan, businesses like Asian Paints, right? Businesses like Nestle. These businesses might be expensive businesses, but they are moated businesses, and hence they cannot be disrupted easily. they will sooner or later come out of cycle in a shining way, and maybe a bad cycle like COVID or bad event like COVID will eventually help these companies, because during these times some of these businesses will actually be able to increase their market shares, and because their cash flows are high, they are not dependent on the borrowed capital. So even a cycle like rising interest rates will favor them. So this is so much now fixated in investors mind that they are kind of not at all wanting to understand that yes, a sector rotation has its own weightage, though obviously numbers, if we talk about recent numbers in terms of alpha, a strategy which follows sector rotation has generated far more alpha than a consistent compounding strategy. But I also put myself in investor's shoe, and at the end of the day I also want to understand the answer to this question from you.
Right, Kamal, very interesting. But what would have happened if you followed this same strategy at the start of 2000? Right, if you started this in 2003, for the next 10 years, your Hindustan Unilever was flat, your Colgate was flat for 10 years. Right? So what one should understand in this scenario is that whatever problems that a lot of investors had during 16, 17, 18, I can boil it down to the few biases that I mentioned. One is the familiarity bias. I said people only invest in sectors they are very comfortable with, and therefore even when the consumption cycle has come in, the funds that have done fairly well during that cycle are not actually doing very well over the last 2 or 3 years, right? So you've just seen the start of that underperformance. You've seen historically that cycles take 10 years underperformance. You invested in capital goods in 2008, it would have taken 11 years for you to return. Great quality businesses like Coca-Cola or Hindustan Unilever have been flat for 10 years. That is the first problem. Second problem is that we are facing a lot of faith in the recency bias. Because this strategy has done very well in the recent past, we believe it will continue to deliver superior returns in the foreseeable future. But if you go back and check the data, that's not what has transpired. The third problem is that a lot of investors got caught up not looking at the cyclical behavior of market caps. There were a few fund managers who exclusively focused only on small cap investing. And at the peak of 2008 cycle, 2018 cycle, they kept on investing into small caps at very lofty valuations. And by lofty valuation, I don't mean say 80p, 100p, but they started buying the pipe dream of embedded value. This is your investment thesis, and then market tells you, Achha, this also can happen, that also can happen. And you keep on sort of investing, which is, I think they get carried away. But if you start looking at this in cycles, and I showed what Buoyant has done, we outperformed in the previous cycle, but did not lose a lot of capital in the cycle that followed. So if you avoid the familiarity bias, if you avoid the bias of recency and start believing that different sector cycles follow, that is going to help you. Lastly, if we are right that QT and QE are different investment environments, and what happens in QT will be different from QE, if we are right there, then you are going to see this buy and hold at whatever valuations underperform even more, because you are not going to have time corrections. Lastly, to your point on these being moat businesses, we forget the fact that our analysis of what moat has been generated comes from the 14 to 19 cycle analysis. During that time, the commodity price inflation was negative. Right? If you look at the Bloomberg Commodity Index, it was down 35%. The oil crude prices was negative growth. So it was again down 35 or 40%. So these companies had no cost that needed to be passed. Look at what's happening over the last 1 year with these businesses. They are unable to pass the increase in crude, increase in aluminium, increase in steel prices. So they're not moat businesses. You analyze them to be moat businesses because they coincided with a good cyclical cycle, and valuations expanded because endowments were very happy to buy a 6% dividend yield and bring it down to 2% dividend yield. That changes with QT, at least in our expectations.
Sure. The last two questions now. One, what is your view in terms of the QT that you mentioned? And there is a next monetary policy announcement by Fed scheduled for 21st September, and obviously we understand that we are now back to the era of maybe quantitative tightening. But as you mentioned that this started in 2014, but then this was put to rest. This time also it has started, and then there is a fear of recession in US, UK. So I do not know, how long will this continue. But I would want to know, because we are basing our argument on this change in the overall, kind of monetary policy, which may be, changing for long term. But yes, is it changing for long term, or will it not change for long term? Are there any logics around it to understand this?
Right, Kamal. So, yes, see, one, we need to see the federal balance sheets and realize that it's gone dramatically higher than what was comfortable for any of them. So, the need of the hour is that, your global reserve currency status allows you only to expand to a certain level. Then inflation goes out of hand, and that's one thing that is dreaded by most policymakers. You cannot let inflation go out of hand. One way to look at this is that you believe that they are actually raising rates in a hurry to create the dry powder for the next recession. And as and when that comes through, they can come back and cut interest rates and forget about the balance sheet. Maybe that happens. That's not what Jerome Powell, however, is suggesting in his Jackson Hole speech. So essentially, they might not want to stop at inflation unless it reaches 2%. Now, the other way to look at it is that when you look at inflation, or how most monetary policymakers look at inflation, is again funny, because when, say, something that is priced at 100 rupees goes to 120, that's a 20% inflation. Next year, if 120 stays 120, that's a 0% inflation, right? So without prices coming down, inflation has come down, and that base effect will start flowing through in October, November this year. So it might well happen that Fed comes to a position where it says that, look, we are already inducing an economic recession. Your inflation is now again under control because the base effect has taken place, and the asset prices has cooled off, and therefore we don't need to worry anymore. That's entirely plausible, but that doesn't change the argument that you're no longer into the period of easy monetary policy. Because if they let their foot off the pedal and inflation starts rising again, they'll have to come down and clamp it down again. So the actual reduction of the balance sheet might not happen as fast as they want. They want to start doing $95 billion a month starting now. It might not happen, but you will have these consecutive periods of ups and downs, which will force the valuations to be checked. And therefore, the prognosis we are proposing might not just be limited if QT happens, but even if this extended QE, QT, QE, QT type scenario happens, you would still see cycles becoming very, very accentuated.
Right, Jigar, it has been really, immense pleasure interacting with you. I think this was one of those webinars which was really very insightful in terms of a lot of learning for me and many of our, clients as well as investors in the audience. We would like to maybe, have another session with you, maybe in the month of October or November, depending upon how the subsequent stances from monetary policy announcements from Fed and RBI come out. And absolutely good luck for continuing to generate alpha on your portfolio. There have been certain portfolio level questions that investors have asked. We will try to address those questions directly, one on one with those clients in terms of portfolio attributes and underlying allocations. We unfortunately cannot talk particularly about stocks, though I can hint that the portfolio is heavyweight on financials, and we have discussed a couple of stocks already. But beyond that, there are many other ideas which are pertaining to sectors beyond IT and pharma, and that is what makes this portfolio very interesting. And I think that is the reason why Buoyant Capital has been generating alpha over a period of 6.5 years. And we have analyzed the data on month by month basis, and we have studied not only returns but also risk adjusted returns, incorporating things like beta, Sharpe ratio, information ratio, based on the standard deviation and other matrices. And that is how we have devised quality, risk, and consistency analysis of a product before kind of bringing this to our audience. Thank you so much once again. If you have any further questions to our audience here, or you would want to kind of know more about Buoyant Capital PMS, you're most welcome to connect with us. I have already, announced the book a call button. It is in the offers section. You can maybe book a call using that with us. We'll be more than happy to connect with you. We have a team of specialists who are certified, experienced, and will be able to take all your questions. Thank you once again. We will look forward to the next webinar next Friday. Thank you.
Thank you, Kamal and everyone. Thanks.